So hi guys, very good evening. This is Kribakaran Rajendran, founder of algo trading firm squareofboards.com. We have Vishal Mehta, founder of Market Scanner, and this is after a very long time we are resuming our enhanced session. So people who are new to this session, so just to give a brief intro, it is nothing but we'll be discussing everything related to markets, be it investing or be it trading. So everything in a quantitative manner, which could help you enhance your overall system performance, whether if you're trying to develop your own trading system or investing system. These set of series could help you out developing your overall performance of your system. So that is the idea behind this series. So in today's session we'll be talking about, will the stock market crash again in 2022? So this is what we are going to address, since the market has been on a downward spiral for quite a long time since this year. So I thought this topic would be really interesting.
So
So
Kiru, wait, before that, I'm going to be a devil's advocate.
yes,
Why there was such a big gap between the session that and now, and what prompted us to come back and do
yeah,
this
because
session? And
the main reason was Vishal was too busy traveling around the world, so he couldn't spend time in conducting the
nah.
session. So I was all alone, so I couldn't do it. Since he's back to India, we are resuming the session now.
No, but I think so. Just to give a perspective, of a lot of people have also reached out to us and told us about, like, how much knowledge that they got it. And we were just discussing, me and Kiru also, during this conversation also, we ourselves also learned and got to kind of put a thought process on a lot of new ideas. Because when people are talking and when we are discussing new ideas, and there is a famous saying, when you teach, you actually learn two times. So that's how I think so it has really helped us and a lot of our viewers. And I'm sure the ones like you, if you're new to this, go back to the previous enhanced session, and there is a lot to be taken from this session. So yeah,
Yeah, very true.
will
And second most reason is, no, we have become lazy, man. Actually, that is one of the reasons that we couldn't post. If we have thought, we could have posted it, but it is the main reason that we have become lazy. And
true.
coming up with a different topic each and every week is really
Every
hard.
week. True. It
And
is.
that
It
you have
is.
to put in your own research. And for this topic itself, no, my whole day has gone to prepare this topic. So it takes
Right.
time, but once you get used to the flow, you shouldn't break it. That is the most, single most lesson that I have learned from this break of an session.
True. True. True.
So we'll get started. So the idea behind this session, or the topic behind the session, is three things. So first thing is, we'll dig deep into the historical market crashes that has happened so far. What are the reasons that is causing a market crash? And then we'll look into historical data of both US markets as well as Indian markets. US markets, because we have 100 years of data with US markets, so we have a vast set of data to go through and to check how the market has performed with respect to US. And also we'll check how the Indian markets has performed during the past crisis and past crashes. And finally, there are people who have been comparing 2020 corona crash with 2022 as well. So we'll differentiate what has changed between 2020 and 2022 current periods. So those are the things that we'll address. To get started with, a question for Vishal. So Vishal, so if you think that market is actually in a bearish phase right now, so what are the biggest risk factors that we are currently facing with respect to stock market? If a market is going to crash in the coming weeks, or it's going to
Mhm.
correct more in the coming weeks, what are the triggering points, or what are the biggest risk factor that you are seeing which could cause this fall?
So the catalyst, you are, if I understand
Yeah.
correctly, what is the catalyst who's going to push these prices? So yeah, interesting, Kiruba, you asked this question. Um, and I'll just take few seconds back. And when you mentioned about me traveling to the world, so I was at a CMT conference in Washington, DC about 2 weeks back. And there was a very interesting thing that came up. And the thing was the commodities. Okay. And the commodity was directly related to the inflation, and inflation was directly related to the interest rate, and that is related to the stock market. So after so many years that I've been hearing people talking about commodities, because I remember when I was reading this, sorry, I'm taking this topic a little off, but it is still very relevant to what we are going to talk about. It's why this crash and everything. But in 1978 and 80s, where a lot of legendary traders that we have read about market wizard on the market wizard book, and I used to wonder why they made so much of money trading commodities. And the interesting part was that was an inflationary period. Okay, and they were all trading commodities. And when all of a sudden now people after 1980 to 2022, it's a long whatever 20-40 years of difference, like maybe that's inflationary cycle got over in around 2000, and after that we never talked about commodities. But this is the first time with China going into a lockdown, Russia Ukraine war disruption, again we are hearing that China Taiwan war, then a lot of again cases, logistics shutting down. Commodities are getting impacted this time. And when the commodity prices goes up, the input cost for the industry goes up. Industry goes up, the cost of purchasing goes up, so the inflation goes up.
Right.
When the inflation goes up, they have to take care of the interest rate, and interest rate is going to crash the stock market. So these are the broad cycle that I believe
Right.
that it
Right.
will kind of crash the market. Yeah. What do
Yeah.
you think?
So yeah, even I had the same perspective. Like for an example, we are getting started with the inflationary period where currently we are at 40 years high inflation period. So in the last 40
Wow.
years, this is the highest inflation period that we have been seeing.
Mm.
And in addition to that, the Russian-Ukraine war has disrupted the oil industry as well. And the frequent lockdowns in China has also resulted in supply chain
Mm.
disruption. So because of that, so multiple chains of reaction has been happening. And in addition to that, because of the rate hikes that has been happening from central government all across the globe, this is increasing the borrowing cost for individual users as well as the companies. So when the borrowing cost is increasing, the disposable income gets reduced. So when the disposable income gets reduced, obviously they'll have less money to spend, which is going to obviously affect the economy, and that in turn is going to affect the stock market. So that is this is the perspective that I also had until I watched an interview from Morgan Housel, who is author of The Psychology of Money. So
Okay.
what he has mentioned is the biggest economy risk is what no one is talking about. So when no one
Mm-hmm.
is talking about it, no one is prepared for it. When no one is prepared for it, damage is too much.
Mm-hmm.
So if you observe historically, so whatever the biggest crashes that we have witnessed, for an example, the COVID pandemic in 19, no one has witnessed about it. No one has thought that a corona pandemic could come that could shut down the whole world. And similarly,
Right.
the global financial crisis, apart from few people, there were many people who were completely relying on to mortgage, subprime, some mortgage
Mm-hmm.
loans and all those incomes that they were generating. All these big companies, Goldman Sachs, Lehman Brothers, they were betting big on the mortgage market. And eventually no one was prepared for such a big crash. And eventually when Lehman Brothers was about to collapse, there was no buyer to buy them out. And eventually, because of chain events, it caused a huge disruption across the world. Similarly, 9/11 attack, which happened, that was completely unpredictable. No one would have thought that some terrorist guys is going to hit at Twin Towers, that too on a world most powerful country. So
Mm-hmm.
all these things were not big, but they were big surprises, inclusive of this Pearl Harbor attack, which was a big surprise that eventually lead to World War.
Well, right.
So when people, the biggest risk factor when we currently talk about inflations, global chain and then the supply chain getting disrupted and Fed increasing the rate hikes, all these things are we are prepared for it. But there
Right.
could be something which we are not prepared for it, which no one would have thought about. That is the one which is going to cause a biggest risk
Mm.
factor. So that is what the history says so far. So now this is another famous quote I really loved. Risk is what is left over when you think you have thought of everything.
Oh, wow.
So that is actually what risk is. So this was a famous quote from some army general who asked about overall the risk factor that they could face during the battle. So this is what he has mentioned. Risk is what is left over when you think you have thought of everything. So be it trading, be it investing, so that is what been happening. So we'll be thinking, okay, what could go wrong in this sense? What could go wrong in that sense? So what if in case if we keep or no stop loss or exit at this criteria? So we'll be thinking so much of things, but eventually market will be coming up with a big surprise, which we would have not thought about it. So that is one of the important factor that we have to give so much of importance to. We
Mm.
always look at the obvious point. We don't look
Mm.
at something which is beyond imaginable, or something beyond our control.
Hmm.
So that is one important thing that I have learned. So once I learned this, I thought, okay, so people who have been talking about inflation and all these things, that could have been factored in already. And second
Right.
thing is, like, when the gold world market is going down, being in a correction mode,
Hmm.
we have not corrected so much. It is just a 10% index correction if you observe. So
Hmm.
a Nifty has corrected only 10% so far, but if you check Nasdaq, it has corrected 30%. That is
Hmm.
mainly because Nasdaq is filled with all tech companies, and being from Netflix to Amazon to every single tech companies is part of Nasdaq. But with Nifty, it is mainly financials and IT. And if you consider IT, it is companies like TCS, Infosys, HCL, Wipro. All these companies are cash-rich companies. So obviously they are more stable. Imagine if Nifty as a constituents includes Zomato, Paytm, ICA, and obviously we would have
Hmm.
crashed more than 30%. So
Yep.
the Nasdaq is crashing higher than our index. It's mainly because of their overall constituents. So that is why our impact is comparatively lesser than the global markets. And second thing is the chart. Are you able to see this chart, Vishal?
Yes, Kiru. I can see the chart.
So this is a chart of S&P 500 index. So for people who are completely new to S&P, it is just like a Nifty index, but this is for US markets. And from 1957 to 2017 is the chart that you're seeing right now, where S&P index moved 200 times in this period. But if you observe closely, those yellow lines, orange lines,
What
and
do,
blue
what do
lines,
you mean? What do you mean by moved 200 times? Means?
like say suppose $1,000 invested grows to 200 times of whatever that you have invested,
Acha, that
similar
way.
to
Oh,
Sensex.
okay, okay. Got it,
So
got it,
like
got
people
it,
who have
got it.
started with Sensex. So
So
similarly
it's like
the
doubling money or 1x or 2x multiple. Yes,
right,
okay, okay. Got it, got
right.
it. 2x.
So over a 50 to 60 years of period, your account has grown 200 times. That is a
Hmm.
reasonable expectation with the equity markets. But if you look closely, there were many periods where the market were in 5% drawdown, where
Hmm.
it was trading below 5% all-time high. And those
Hmm.
orange periods or those phases where market was trading below 10% from all-time high. And those
Hmm.
blue lines that you see around 7 to 8 times are the period where the market was trading below 20% of all-time high. So there would be phases of all these different drawdown periods that market goes through. But eventually, on the longer period, just when you zoom out and see, obviously, the returns are much higher. So a 5% drawdown could obviously go to a 10% drawdown. A 10% drawdown could go to a 20% drawdown. So nobody knows clearly whether we could currently with 10% drawdown we could go to a 20 or 30. So
Hmm.
that nobody could say it. But what we could say from learn from the historical data is these drawdowns or these percentage of drop from all-time high is so normal that even in 60 years of period with an S&P index, an S&P index which spends so much of time in the drawdown period, but eventually it recovers out. So
So the
that is,
problem with this chart is, Kiru, we always think this time it's different,
yeah,
which is not
yeah,
the case.
right,
Because
right,
that's the most dangerous thing. Because every time when we go through a drawdown and we say, no, this time the market will crash big time, and then market again recovers.
right,
Again,
right.
this time market crashes and we think, no, no, it is going to be the biggest crash and the market recovers. So this time also we will think that this time it is different, but market eventually will recover in the future. It has to go up. Yes.
Right, right. And this is a study done by Nick Miguel, and like he has studied from the Dow Jones industry of data. So
Mhm.
altogether of Dow Jones data, what he has concluded is if you have bought Dow Jones at an all-time high during any of the period from 1915 to till date. So
Mhm.
if you're buying at the all-time high, so it could be at any time, it could be 1920 or it could be 2000 or it could be 2007. When you're trying to buy at an all-time high, the following 1 year return is 9.6%. So which means
Mhm.
that the buy when you're trying to buy the index at all-time high, it need not going to give you a negative returns. It in fact given you a positive returns of 9.6% the following year. It is mainly because of the momentum factor kicking in on the law of large numbers, because as long as the market moves up, it tends to move up in the same direction. So obviously when the market is at all-time high and when you're trying to get in at that time, the following 1 year period median returns is around 9.6%. So he did this study with under 1915 to 2017, more than 100 years of data, and he
Mhm.
did that same thing in case if you're buying the market at 10% drawdown, which means that instead of buying at the all-time high, you wait for the market to correct 10% and then you buy it. What would be your next 1 year returns? Surprisingly, the next 1 year returns is just 5.5%. So when you're trying to buy at an all-time high, your returns is 9 point something. But when you're trying to buy at a 10% drawdown, your returns is reduced to 5.5 off of it, mainly because again the momentum factor kicks in here. Because the 10% drawdown could be in a 15% drawdown, could go to a 15% drawdown or a 20 or even 30. Nobody knows about it. But it takes time to recover from these drawdown phases and eventually come out of it. So it could be, any time. It could be 6 months or 1 year or whatever the time period. But the study states that the 10% drawdown when you're trying to buy it at that point of time, it could give you a far lesser returns than buying it an all-time high. So that is what the 100 years of data states. So it's need not be necessary that you just buying at a 10% drawdown. Okay, I've just bought at the exactly cheaper valuation or cheaper price. Tomorrow if it goes to 20%, you will feel sad. Okay, I should have waited more. But timing this market is really difficult. So nobody could time the market. So have you ever timed the market, Vishal? Have you ever thought, okay, 2020,
So
have you ever
as a,
thought, or 2008, have you ever thought like this is where the
so,
market is going to bottom out?
so as a technical analyst, my job is to time the market. But I've been very honest with you. It's like a very difficult thing. I have not been able to do it. Luckily, I was able to, and there was a tweet I put it out, which showed a very good resemblance of 2008 and 2020, kind of seasonality and the patterns. But yeah, bottom. So timing the market is virtually very difficult. I think so. Very few people can do it. I'm not one of them for sure.
Right, that is very hard. That is highly impossible, actually. No, that is what, because every time the market falls a little, we worry that it is going to fall a lot. So the moment
Right.
1% or 2% is fine, but no,
Mm.
more
You
than
cannot be you cannot do it consistently. You
correct,
cannot predict it consistently. Yeah.
correct. And the thing is, the 2020 crash has given a lesser pain than the current correction, is because the 2020 crash was very swift and very quick. It suddenly went down and suddenly started moving up. But this one is slow and gradual. Even though the broader index is corrected only 10%, there were many mid caps and small caps that has corrected significantly. And many companies has lost more than 80%. Consider Paytm. So that has lost and Zomato, and all these companies are trading at all-time low. And surprisingly,
So
LIC also came out this time. They wanted to dump all the shares. They thought, okay, this is, if I don't give this at this time, definitely I won't be able to get any price. So they thought they're giving it a discount. But even after the discount, it is still going low. But
so there is a famous WhatsApp group message that came in. LIC never gives premium. They always take premium. So in an IPO also, you never got a premium.
right.
Yeah.
And that is the case with most of the PSUs. No, PSU are still there because of dividends. No,
Yeah.
people, okay, it is giving 10%, it is giving 12% returns. So even if it is not making big up move, neither it is not making big down move, I'm okay, even if it's not making any returns, but still I'm happy with the dividends. So that is why all these companies like RFC, PFC, REC, PFCs, and all these companies which is having a high dividend yield are still there. Those are cyclical. Sometimes it will be moving up 20-30%, sometimes it will be moving down 20-30%, but it gives out dividends of 8 to 12% consistently year after year, because the people who are getting dividends are nothing but the governments. They are giving back, they are taking it back. So they're not actually giving it to the public, so they're actually taking it back. So to give a brief historical declines that we have seen so far with respect to Indian markets. So we have first decline started in the year 1992 to 94. That was the during Ashit Mehta scam. So where the market declined more than 55%. That was the first time. That was followed by 2000, 1999 to 2000 during the dot-com bubble burst, where again market crashed more than 53%. So that was the second crash, and the third biggest crash was around 60% when the market declined during the global financial crisis. So, if you observe between these three charts itself, as the market goes or as the market matures, the period of downward spiral is very fast. If you observe 1992 to 94 took 2 years. Again, 1999 to 2002 it took 2 to 3 years. But global financial crisis from January 2008 to 2009 April, that's all within 1 year, it bottomed out. and demonetization did not give a big downside move, but it almost gave a correction of 25%. But again, the 2020 crash, which happened in just 1 month. So previously it was 3 years and followed by 2 years, and then it was followed by 1 year. And now we are currently, the last crash that we have seen is only for 1 month. So in 1 month, we have seen almost 30% decline in Corona crash. And currently we are at around 10 to 11% of decline. So all these declines, if you observe, so it's similar to what we have seen in the S&P index. So no matter what kind of declines that is happening, but eventually it is moving up. So it almost gave 5,200% of overall returns from 1991 to till date. But people who have how many people could stick to their investments during those highly volatile periods? So that is the question. It depends upon the stocks that people were buying. The thing is, we always compare our portfolio with respect to index. So say suppose I have a stock which is down almost 30% and the index is 10%. We do not, even though we know our stock is not part of index, say suppose if you're buying Reliance and then comparing it with index, it's fine. But you are buying some Kekran Mekran company, some Suntech, some Pharmatech, which is not at all part of any index, obviously you will compare it with the index. So when the moment is so high, then you tend to panic, it will not give you the comfort to hold on to it for quite a long time. So obviously you'll come out of it. So that happens with but if you are sticking to an index fund, if you have stayed invested in Nifty Bs or any of the index fund, obviously whatever the index is movement happening, the same movement would be happening with your portfolio, and you will be more comfortable holding it. So the probability of you being a long-term investor with the index funds is much higher than you being invested in any of the specific stocks. So even the next chart is, so forget about those 50% declines. Let's focus on 10% declines. Since 1995 to till date, there has been separate 17 different instances where more than 10% declines happened with Nifty. So 17 times so far, there was the number of drawdowns or the number of periods where the market trading below 10% was significantly higher. It is almost 17 times it has happened. But if we dig deep and if we check each and every time, whenever these kind of downside movement happens, the recovery is so big. Say for an example, after 2008 crash, it moved up 120%, and followed by again 2013, it moved up 93%. And after the 2016 demonetization period, the market moved 75%. And eventually after the 2020 Corona crash, after March, it moved 107% in the index. So all these moves that happens after the market corrected are very big moves. So whether you're staying invested or whether you're making no use of these declines is completely up to us. So we don't need to be, definitely we can't time the markets, but corrections are good, crashes are good, provided we have cash to buy more, provided you have an portfolio which you could stick together during those adverse periods. So that is
So
something
there is
very,
a famous saying, right? Timing in the market is not important, but time in the market. So how much time you remain in the market is more important.
very true, man. Even this quote, I loved it. So there are decades when nothing happens, and there are weeks when decades happens. So for
Wow.
many decades, it
Wow.
could be like no plain, nothing could happen. But all of a sudden, in just 1 week, so much of thing could change. So that is what has happened in 2020 in few weeks. Nobody thought, like I myself personally know many restaurants have shut their business, many gyms have shut down their business, and that is the drawdown that nobody has ever thought in their respective business. So because until then, everybody thought that food industry is the best recession proof industry, because obviously no one will stop eating. So that is what they said even in 2008, because when
Right.
recession was there, food industry was there. But 2020 came as a big surprise for all these people. And people who were over leveraged, like people who opened multiple different outlets, multiple different branches within short period of time, they were crushed. Like obviously they couldn't survive, they couldn't pay out the salaries, they couldn't even survive those lockdown periods. The moment they were somehow survived and came back, the second lockdown came in, that totally crushed them. So for people who have not leveraged, people who are happy with just one or two branches which they were able to manage well, they did it. So this is exactly what is happening with respect to markets also. So if you're too much leveraged, if you're over leveraged, obviously it is going to affect when the unknown territory, when you are entering into the unknown territory. And that this is something that I recently found out. It is like now many people are holding stocks, right? So some people are holding stocks which is very concentrated. They'll be holding only one stock or two stock because they are very have a firm belief in those stocks because of fundamentals or because of any factors. But no, there is a study that has been done where if what is the total number of stocks that you have in your portfolio and what is the total standard deviation. So the lesser the number of stocks in your portfolio, higher the standard deviation. So for example, if you're having only one stock in your portfolio, the standard deviation could be 50%. I mean, 50% of overall SD. And from one stock, if you are having five stocks, then your total portfolio standard deviation reduces 50%. So from 49%, it comes to 25%. So it is, say, suppose more people are doing, another problem with respect to back testing is, say, suppose you back test with the basket of stocks and you see, okay, instead of going with five stocks, if I go with two stocks, my returns are higher. It could be higher, but the standard deviation could be so high that when you are now going through a heavy drawdown phase, it could affect it. So it is always wise to diversify your overall portfolio with 5 to 10 stocks so that your overall standard deviation goes down drastically. So that is why diversification helps when when the shit hit the roofs. So instead of having a concentrated portfolio, if you are having a diversified portfolio, obviously that will help.
But Kiru, when you have a 10 stocks and market goes down, all the 10 stocks are going to go down. So why, just having a diversification, why don't put into one stock and then just run that? Yeah.
So the idea is obviously, so when the market goes down, so that's a very valid point. So when the market goes down, so it doesn't matter whether you are having one stock or 10 stocks or 100 stocks. Obviously, it is going to bring down everything. But no, when you are having it allocated different sectors, the percentage of, say, suppose if the market is going down 40%, your portfolio could go down up to 30%. So it's not necessary that it will not go down. It will go down, but the certain extent where the how much extent that it goes down would be significantly lower than the overall market. So it is, we are having a diversification not to control the complete downside. The downside will be there, but the extent that it goes down will be far lesser. And the third thing is the last three slides that I have is the 2020 crash. So the chart that you see right now is the chart between January to May. It is nothing but the absolute daily returns in these months. It is nothing but, say, suppose yesterday the market closed with 1% up move. Today the market closed with minus 2% downside. So tomorrow, if I have to calculate, it will be like yesterday 1 plus today 2, adding it together, it gives me 3. So you remove these plus or minus thing and come up with an absolute numbers and add all these absolute numbers for the month. So whether the market is moving up 4% upside or moving down 3% downside doesn't matter. When you're adding the overall daily movement returns into a total summation, and then if you plot a chart, March 2020 is the highest ever recorded movement that we have seen in the complete Indian history. So until then, it was just like 10% or 20% movement is the overall monthly movement that could happen. But March 20 has witnessed 80% of overall absolute movement that has happened in one single month. Even on
And this is for India or this is
for
Nasdaq number?
Nifty. This is for Nifty.
Nifty. So maybe there are year-end booking that happens.
No, even see, this is the 2020 crash that happened with Dow Jones. So this is from 1920 to 2020 for 100 years. If I did this same cumulative of absolute percentage movement on a monthly basis, this is March 2020 is much bigger than Great Depression in 1929, and again the
Wow.
biggest crash in 1987. Even it was much bigger than 2008 global financial crisis. So it was so big that it has never seen historically that neither Indian markets nor US markets have seen such a big volatile movements. So when you compare that with 2022, we are nowhere near that. Even January, February, because of Ukraine and Russian war, there were a movement of 15 to 25% of absolute moves. But if you see April and May, we are actually getting slowly on a lower volatility period. So obviously, I feel of all these data, I could see that the volatility could subside generally going forward, then increase. And definitely we are nowhere near to 2020 crash. That was absolute madness. But what we are witnessing now is could be the same, obviously, because of the all other reasons that we have discussed. there could be a huge sell off, but it is happening gradually. So it is not having a significant movement or significant impact compared to 2020.
Mhm.
So 2022 could be a correction period, could be a sell-off period, but I guess it is not so big as 2020. It could be slow and steady. No, who knows? Probably we could go lower and lower, but the percentage of movement that is happening on a daily basis is much lesser than what we have seen in 2020.
It is like a cut by thousand cuts, death by thousand cuts.
Yes, man. Even see, this is my portfolio. So,
Okay.
I have only two stocks. One is Apple, and the next one is
Okay.
Reliance. Apple, I bought
Okay.
it during the 2020 crash because
Mm-hmm.
that was the time that I saw okay, that was available at attractive price. So I bought it. That's all. I did not buy it. After that, I did
Mm-hmm.
not buy it. Reliance, I just bought it recently. But what
Okay.
I have realized is what you
Mm-hmm.
buy doesn't matter. When you buy
Mm.
matters. So as long
Mm.
as when you buy is really a good price, it doesn't matter what the market is going to do. You'll actually hold it for a long time. Other than that,
Right.
all the SIPs that I did is only with index. So obviously index did not also correct much even. So overall my portfolio did not damage so much in this period because
Mm.
obviously I have allocated between debt and again with stocks and again with index. So it did not have a
Mm.
bigger impact. So the only way to survive this period of 2022 is it is not as going to be as bad as what people have imagined, but even if it happens, it is going to be slow and steady. So in that case, if you have to survive, obviously the two things that we have, as I said, so just stick with index funds if you're not able to handle the volatility of individual stocks. And second thing is, if you are going for an individual stocks, better to diversify with different sectors and add debt to debt or bonds or don't put all together in the equity. You could just subtract your 100 minus your age and put that in
Mm.
equity and remaining in debt. And if you have that kind of concentrated, diversified portfolio, that could help us to sail through this rough phase. Definitely, no one could say that market is where the market is going to be tomorrow. But if we can just get prepared for the worst, obviously we could sail through it.
Mhm.
So
Yes.
that is what I wanted to
Okay.
I guess I have
So I
done.
have a very, very, very basic question, Kiru. How
Yes.
do we define the bear market? Like, when do we say that we are in a bear market?
When do we say bear market? So we can say like market if it is going below. People would obviously say okay, market gone below 200-day moving average and all
Okay.
technical parameters. But I would say when every single guy is saying sell off your portfolio, market is not when we are actually in bear market, and people have not
Okay.
yet touched that particular place so far. So that panic is not is there. The moment that panic is there, obviously the bear
Yeah.
market is going to end. So that is not the start
So
of a bear market.
there is a famous saying, there is blood on the street, but as of now, there is no blood on the street. So yeah.
Very true, man. Very
No,
true.
I think so it was pretty interesting to see how the recoveries are, and what I think so I liked in the presentation to build my thought process. Even if I would have bought at an all-time high, and if the prices would have come down at next year, I would have been positive. Obviously, the stock selection matters, because here we were talking about index. There
Right.
could be a situation you would have bought a stock that would have never come back. So it's like a specific advice: don't try this at home, or maybe
And
don't
more
try it
important point,
at the stock.
yeah, more important point is the longer the period that you hold, lesser the risk.
Mm,
So no,
risk.
it could be for 1 year, 2 year, that's fine. But no, as we see in 30, 40 years of data, the risk
Right.
goes down drastically. So a guy who's holding an index for 10 years or 15 years, whatever be it stock or index, there is a 99.99 chance that the returns is going to be in a positive note. So higher, longer the period, we don't need to be worried too much about the
Okay.
market fluctuations. This too shall pass.
Awesome. Awesome. So I think so there are quite a few takeaways for me as well to how to look at the bear market. And maybe next time, or maybe when the opportunity comes in, we'll try to build a session around how do we go about building a portfolio in a bear market.
Sure, sure.
Because we have understood now bear market, but now we have to take it into a what you call it as a workable solution. So maybe next, maybe not next, but whenever there is an opportunity, we'll create a session on that as well.
Definitely, definitely, Vishal. So thank you so much, guys. This is the end of the
Thank you.
session. So next session, I know Vishal will be coming up with an interesting topic. So
Topic.
guys, in next week. Thanks, Vishal.
Done. Thank you, Kiru. Thanks a lot, everyone.
Thank you.